Welcome to New Money. I'm Bryan. This evening we're focusing once again on the investment world. Fortunately, my two guests this evening will be able to answer questions put to them which has puzzled me over the last week. The first being that the American economy may be slowing down. I was under the impression that this would be positive for market as it will allow interest rates to be cut in the US in the next few months. The second relates to dovish remarks made by Powell, head of the US Federal Reserve, and on this score, markets also reacted negatively. Joining this evening is David Shapiro, Chief Global Equity Strategist, and Craig Feifel, Chief Investment Strategist, both from Sasfin. Guys, thank you for joining me.
Hi, Bryan.
Craig, help me. I was puzzled by that. I mean, I thought those two were quite positive for markets, not negative.
I think it's difficult on a day-to-day basis to try and interpret any of the Fed speak or the daily economic indicators. The market may expect one thing and we come out with something a little softer or a little different and the market goes even contrary to where you think. I think you have to look at it in the context of where the market is at the moment. I mean, the US market, S&P, making new all-time highs. We made about 9 all-time highs in February. It's continued to be strong. I think your premise or your theory that lower interest rates should be good for the market, but those lower interest rates come off the back of lower growth, and markets need growth. Companies need the growth to grow their earnings as well. So you could look at it from the other side of the coin. But overall, I think just looking on a day-to-day basis and trying to interpret these things is probably a mug's game.
Well, David, you know more about that because I talk about at the end a particular athlete, and I won't give you the just now, who talks about markets being a marathon, not a sprint. But we talk about when markets are positive and sentiment's positive, markets go up, and conversely, when sentiment and fundamentals are negative, it's when they're out of sync. And at the moment, it's always the sentiment that of the day's news that has an effect on the day's markets.
Exactly, but ignore the noise. Ignore that daily fluctuation. I think we are going into a year where interest rates are going to come down. It might not be June, it could July, August, and Powell has said that. Everybody said that it could be next year, 2025. Powell has said it could happen this year. Of course, he's going to couch it in a way that doesn't give away too much. But I think that's where we're heading. Rates will come down in South Africa, rates will come down in Europe, rates will come down. And that's always good for markets, even though we might be discussing the quantum. So I think
that was another thing. They said, yes, rates are coming down. And then the question was, by how much?
Well, the media have to have something to talk about every day. And I think it was much better in the olden days, in the telegraphic days, or hundreds of years ago, where you'd get a newspaper once a week. But here we have to make news every day. But I think, Bryan, to cut out all the noise, we are going into a period where we might be in low growth, but lower interest rates will eventually lead to higher growth. So I think keep that as as your focus.
Because, David, there will be some companies that will benefit from low interest rates because some of the counters you hold in portfolios have been affected, even though good stocks, I think of one Next Era, we've spoken about that stock, but not that we talk about stocks on the show, but some will benefit from low interest rates.
Well, that's what we keep asking Craig. I keep saying, Craig, rates are going to come down. Where should we be buying?
I think especially those stocks, those companies with a lot of debt. Yeah. Those are the ones that are going to benefit the most with lower rates. It means they pay less interest, so the expenses are lower, and it kind of just falls to the bottom line. So those are the ones that could just grow earnings just by doing the same that they've been doing in the last year, but paying less in interest.
David, would that give you a different view to the magnificent 7 or 10 or 15? I mean, I love it when they talk about the magnificent 7, then one gets shot. You remember in the movie, one gets shot, so it becomes the magnificent 6, and then we add to those. But, I mean, when you look at a portfolio, would you change much? I mean, well, let me ask you the first question.
Yes.
Do you think we've entered bull market territory?
I think we've been in bull market territory for some time now. We have to push South Africa aside because it's a different dynamic. But globally, I think we are in a bull phase. But you're right, we have to keep thinking that way. Should we keep our tech or should we start switching? And we're asking those questions all the time. I don't think you have to give an answer today. But sooner or later, there will be a time where you can maybe ease out of your tax or take some profits and start looking at. I'm looking at the U.S. housing market. I don't think the housing market's going to take off. But people, as Craig said, will have a little more money. They'll start to spend on renovating the houses. They might spend on actually new houses. So I'm looking in those kind of areas. Okay, what can we start identifying as our targets should rates start to come down? So yes, you're in the right phrase. That's and even banks might start to benefit because there'll be more activity. People will become a little more aggressive, a little more daring. So
people always
definitely.
ask me, why do I hone on so much when we're talking about an investment program on international markets and not South African markets? And I've always had a strong belief, if you're looking for long-term growth, and when I talk long-term, you're taking a 5-10 year view, and if you're an older person, you're talking about, I'm never going to use that capital, it's going to be for my children, then I believe that's the place to be. And if you're looking for income, there's no doubt about that, this is the place to be, Craig.
I want to ask you a question. Craig will appreciate. Why do you watch Man United versus Liverpool? Why do we watch those and we don't watch local football? Because we can. Do you know what I'm saying? We can watch international sport. We can internationalize our lives. And I think I don't invest in geographic areas. I invest in companies. But I think that explains it. We do it because we can.
Craig, money moving out of South Africa. I mean, we've seen bond rates weaken a little bit. They were in the 970s, 980s, certainly in the 10-year bond, now 10, 11. Is money leaving South Africa? And is it leaving from equities and bonds or just one of the asset classes?
I think it's a general outflow, and we saw it quite a substantial outflow last year. And we had a number of incidents, one-off kind of incidents, but that just maybe tainted our reputation a bit. We had the Lady R, we had grey listing, even the last budget, although the outcome seems to be positive in the short term, you're also kind of sneakily taking money from the currency reserve fund, and maybe the market or the international investors don't think that that's a really lasting solution to our problems, to our high sovereign debt levels. So there's a number of those factors. Big current account deficits just swung again this last month. So there's a lot of reasons why we're not going to see flows in, and foreigners have this kind of bit more jaundiced view of the country, and also interest rates around the world are higher as well. There's no need very often to take the higher amount of risk for the interest rates that you can get here if you can go somewhere else for a lower level of risk.
David, I want to talk about something that is two slides I've shown before, but I want you just to spend a bit of time on it. These are the first slide talks about the composition of our market, and maybe we can just put up that slide for our viewers to see. Just wait for my control room. There you are. Okay, David, talk us through that slide, because although most of investments are linked to rand hedge stocks, exchange traded funds offshore, it hasn't translated into performance.
No.
So just and I can't understand it. Just talk through that slide.
Well, if you look at that, and I think maybe 70% of the JSE earns most of its income revenue outside of the country. In fact, a lot more. And then we've got the miners as well. But when we look at the composition of our so-called offshore companies, they're old economy stocks. And what I'm saying now doesn't only apply to the JSE, it applies to the UK market and applies to European markets as well. They haven't got the Magnificent Seven that you're talking about. They're made up of a lot of older type business. They haven't transformed the way that the US economy has. So if you go through BHP, it's a miner, and we know that commodity prices have been under pressure. If you go through AB InBev, it sells liquor, it's a brewer. And those companies are also battling. So I think that's one of the reasons, even though they're offshore businesses, they're really old economy stocks that haven't grown like the Magnificent, the Amazons and the Apples and the Alphabets and the Nvidias and so on. So the American market is quite unique.
And you need to add to that some of the pharmaceuticals.
Oh,
You
yes.
need to add some of the PayPal
Weight loss.
systems
Oh, yes.
and luxury
Yeah.
companies like
Yeah.
Louis Vuitton and Verizon. You need to add those to those magnificent
Those have been exceptional. So I think, if I had to put down my themes, and very briefly, it's been those companies associated with artificial intelligence, a handful of luxury companies, and also the weight loss drugs. You put those three, those have been the drivers of the markets. Everything else has not really contributed. Maybe Craig could add something around that as well. But when you break down businesses, that's where the drivers have been. And if you've been lucky enough to be there, you've done incredibly well.
Okay, so I'm going to put up the second slide, because we always talk about rand head stocks. And the green line is a bit concerning, because the green line on this graph shows the performance over the last 10 years converted to dollars. And the green line talks about South Africa.
Yes.
And yet all the earnings are from South Africa. 70 to 80% are coming from offshore companies.
Have a look at the other two lines, the yellow and the mauve. I don't know which color that. I'm never great at describing colors. Purple, mauve, whatever it is.
Well, at the top is obviously $100.
And that's because of the Magnificent Seven and those tech companies. But have a look at those others. Those markets, European, the UK, and South African markets haven't done well relative to to the big tech company. And that's the drivers. Everybody's saying, is putting pressure on Europe, putting pressure on the UK, putting pressure on even South Africa to change the composition of the economies.
Okay, so Craig, let me ask you a question now. We talk about AGOA, and we talk about the benefits of AGOA, and we talk about there's a bill in the Senate looking at South Africa's involvement in AGOA. What are the benefits and what are the dangers? You spoke about South Africa and the difficulties in money leaving. Is it possible that we could be removed from the AGOA agreement?
I think it's quite possible. Whether the actual impact in rands and dollars is material, is maybe it isn't so much. I think it would be a fractional impact on GDP. So, it might have had a bigger difference when it came in the earlier years in 2000, when we were big exporters of vehicles and the like. We would have benefited then a lot, but I think that benefit has dwindled over the last 24 years. And if they took it away tomorrow, it probably wouldn't make a big difference to GDP. It would be negative, but it would be small. I think the biggest impact, though, is just on what we were talking about earlier, our just how we perceived by the rest of the world, by the international community, as a poor destination for investments. And I think that's probably the worst of it.
Well, we'll touch on them when we come back, and then we're going to deal with emails. We're going to take a break. Stay tuned. We'll be back shortly.